Welcome to another edition of Focus on Alternatives, brought to you by ADISA, the Alternative and Direct Investment Securities Association. For more educational content like this, please check out the resource library at adisa.org. My name is Greg Mausz. I'm your host for today, joined by Warren Thomas, Managing Director at ExchangeRight. And Warren, I get to say welcome back. We had a conversation on our videos series about 3 years ago. So good to have you back in the studio.
Thank you, Greg. Appreciate being able to be here.
So today we're talking 1031 and 721 transactions. Just to level set, can you talk us through and define those terms and the differences between the two?
Yeah, happy to do that. So a 1031 exchange is an exchange of a property held for business or investment purposes for another property held for business or investment purposes. And 1031 is actually a code section in the Internal Revenue Code. It's been around a little over 100 years, and it allows an investor to sell their property, to reinvest, and to not have to realize any gains and pay tax on those gains, either for a state or federal basis. So that's the basic 1031. There's lots of choices as to what you could go into with a 1031. You sell your rental property, for instance, and you might choose to go into commercial property or choose to go into another rental property, but you have many choices in that context. Under a 721, it's a bit different because a 721 exchange, yes, it's an exchange. It has been in the tax law for many decades, but you're actually exchanging your interest in your property for an interest in an operating partnership of a REIT, a real estate investment trust. So you are going from a property that you may be owning and managing, and if the REIT was interested in buying that from you, you could exchange it into the REIT and they'd give you operating units in the REIT. And that is done under a 721 exchange. There's a challenge with that, though, because the REITs that are in the business to make money, they seldom will want the small rental property that you may be managing. Even if you're managing a 30-unit or a 60-unit property, it may or may not fit their goals for their REIT. So there is a two-step process involved for going from a rental property situation actually to the REIT that might be your final destination.
Okay, so thank you, Warren, for laying that groundwork. If a financial advisor has an investor and they're looking at this property, what are kind of the factors of when an advisor would recommend an exchange with a 721 option versus just a regular 1031 exchange?
Yeah, so there are various structures involved in these 721s, but to get to the 721 exchange, first, the advisor needs to be aware that they need to do a 1031 first into a program, likely it would be a DST program, a Delaware Statutory Trust program, that has as its ultimate goal to have that DST purchased by or exchanged for units in the REIT. So it is a two-step process. So your advisors need to look first at the needs of the client. Does the client want to go into the REIT? And are there programs available where they can go into a DST that will be called into the REIT? And there will be multiple options that they could consider. There are some programs that go directly from the DST into the REIT after a holding period, which we can get into that in a few more minutes. But there are other programs that allow the investor that goes into the DST to have multiple exit options, one of which may be going into the 721 exchange into the REIT.
So I kind of think of that as a traditional 1031 investment, where you're 1031 into the property, you're going to be invested in that for 5 to 10 years. At the end of that period, the manager then recommends to the investors, hey, let's sell this property, and then you can take your money. But then I guess the way the documents are written today, there's also this 721 option. So can you just walk through the kind of the traditional exit, but then also this
Yeah.
accelerated 721 option.
So we'll go a couple approaches here. So under a typical DST, and if we go back even 5 to 10 years in this industry, your typical DST, you simply held the DST anywhere from, say, 4 to 10 years. And at the end of that 4 to 10 years, there would be a sale of the property, and your investor could either cash out or they could do another 1031 and buy another DST or buy whatever they wanted to under a 1031 exchange again. Over the last particularly 5 years, you've seen a change in the industry where these programs have been coming up that have 721 exits built into them. And either the 721 exit is the only exit that they're offering to the DST owner, or they're offering multiple exits, one of which would be a 721 exit. So it depends upon the program that the advisor is evaluating as to whether it is a 721 only exit or a multiple exit possibility. Then once we get into that discussion, then you will look at the 721 only exits, and many of them are built to have only about a 2-year hold period. What they're trying to do is you do the 1031. You don't want the IRS to say, hey, you always intended to exchange not for a 1031 property, but for units in an operating partnership or units in a REIT. We want to get past a 2-year, what appears to be a safe harbor, which allows you then to go into the 721 without IRS challenging the transaction. And what transaction would they challenge? It'd be a challenge to the original 1031 exchange if they were to challenge it at all. So you do see particular DST programs that only have that 721 exit, and you'll see them with as little as about a 2-year hold, and you'll also see those that have a little bit longer hold where it's a 721 exit only, where it may be 3 to 4 years. Under the more traditional model where you might have multiple exit opportunities from your DST, one of which being a 721, you'd expect that hold period to be a little bit longer and likely to be more like 4 or 5 to 7 year hold period.
What's great now is that investors and advisors have choice of sponsors, but choice of these exit strategies. But there's definitely tax and estate planning implications here, depending on which path you choose. Can you walk us through those?
Yeah, I'll walk you through a little bit on the estate planning side. From an estate planning side, I'll first start with the programs that have multiple exit options. If you have a choice of being able to cash out your investor or do another 1031 or do the 721, you look at the age of the typical investor that's coming into the program, and they're typically going to be a retiree or maybe a pre-retiree. And from an estate tax planning standpoint, they're really exchanging until they can get that step up in basis, because a DST will qualify for a step up in tax basis on death, just like owning stocks or your personal residence or your rental property. So one consideration that investors might have, and you might have for your investor, is are you able to get out of the program when it goes full cycle if your investor has passed away during the hold period of the DST? Because you may not want to go into a 721 at that point. Okay, you may want to be able to simply cash out. So some of the programs are built where you have that cash out option. And then you also have those investors that for estate planning, they don't plan to be out of the industry forever. They may be planning to pass assets onto their children who want to manage the assets. And yes, they're in a DST today, but they may want that DST asset when it goes full cycle to give their children an opportunity to stay in the rental property business. And so that 1031 exit from the DST may be important for them. On the other hand, that person may just not know what they want to do. And they want that option, those two options, yes, but they also want the option of having a 721 available. So that's on the one hand. Now we go to the other side where it's the accelerated 721 only option. And under that option, from an estate tax planning viewpoint, that's a pretty good option too, frankly, because it qualifies, once they do that 721, it too will qualify for a step up in basis. So now they own operating units in the REIT, and those REIT units get a step up in basis, and most of these REITs have liquidity built into them so that they can cash out either quarterly or even on a more frequent basis. So you get a step up in basis, and then you have the opportunity to pass those assets on to your heirs with a step up and cash them out. That's pretty attractive. So there's a place for both tools in your toolkit.
That was a lot, but you did a great job of breaking that down. On the traditional scenario with multiple exits, you can analyze whether or not you want to go into that REIT as part of that 721 UPREIT transaction at that time. Now, if you're doing the accelerated 721 transaction, I imagine you'd be trying to analyze that in REIT at the time that you're actually doing the 1031 transaction so that you ultimately understand where your investment's going to be. Correct?
Absolutely. So it's so important for a financial advisor to have underwritten, to the extent that they can, what that ultimate REIT is going to look like. And if you're working with a company that is doing DSTs that has never formed a REIT, but they're trying to do a REIT exit, and they want to make that available, but they don't have a REIT to evaluate, then just take that into account in your risk analysis. If you're working with a company that has a REIT in place, you absolutely want to look at what the basics are on that REIT. You know, what's their cash coverage, their AFFOs, how much debt are they carrying, is it fixed, is it variable, what do their leases look like? You want to look at all of that up front, and you're going to make the best determination that you can make, knowing that it may be 2 years to 4 years from the time that they'll actually choose the 721.
There's many benefits of executing a 721 and going into the REIT, right? You get diversification, then have the liquidity options. So it's a great long-term planning tool, but there's no way of 1031 out of a REIT once you've 721 in, correct?
That's correct. So you're in it to win it or
Nice.
to lose it. Yeah, so once you go in, you do not have the ability to do another 1031. You're really waiting at that point for the step up in basis to occur, giving your investor an opportunity to cash out. Or the investor may, if you've gone into a good REIT, there may be no reason to cash out. It might be just part of your diversification tools that you'll employ for your investors.
And specifically on this, what are the latest trends? What are advisors and investors doing when it comes to 721 transactions?
Yeah, it's a great question because the industry is changing so quickly. We're finding a lot more of the larger institutional money managers. They are looking for the 721 only exit. And why would that be? Well, if they are working with REITs that are of sufficient size to where they can evaluate them effectively today, then they have a pretty good idea of what they're going to look like in 2 years. So they're taking some of that risk out from where a normal DST, when it's time to reinvest those DST dollars, you're looking at a new product again. You're evaluating a new product. In the case of a mandatory or accelerated 721, you're looking at a REIT. It will probably be much the same in 2 years as it is today, and it makes the underwriting process a little bit easier for the typical financial firm. Also, it brings assets under management long term. And so every financial advisory firm, they'll have their own policies on how they might get paid, but in general, they see that as additional assets under management or assets that they're capturing that they likely were not capturing 3 or 4 years ago.
So these advisors have a lot to evaluate when considering these transactions. Looks like it's an ongoing conversation with the client, kind of in real time, evaluating programs that are out there. How do sponsors support advisors in making investor-centric decisions?
Sponsors should be aware of the long-term nature of these holds, and they should be structuring their deals to reflect the commitment of the investor to that program over time. And what that really means to us is that we need to be very careful not to be overcharging on asset management fees, on property management fees. We need to make sure we've got liquidity provisions built into the product so that the investors can exit that 721 product when it's time. We also need to have valuation metrics in place. In our case, we have the program valued, the underlying assets valued every quarter by KPMG. And so you've got to have those guardrails in place on all of those levels in order to be investor-centric with your product.
Warren, thank you for walking us through this 721 conversation and the differences and how we can continue to prioritize investor-centric thinking. Really appreciate it.
Okay, thank you, Greg.
And thank you for listening to another episode of Focus on Alternatives. Again, for more content like this, please visit adisa.org. And we'll see you on the next episode.